I'd like to thank the Accounting and Finance Show for the opportunity to speak to you all today. This presentation is about blockchain technology and its applicability to finance and the financial systems we interact with on a global and local basis. So, blockchain is a fascinating technology that has the potential to transform the way the world does business. It is a robust and resilient computer network that makes it possible for the first time in history to enable micropayments over the internet, as well as a whole lot of other things. In 1999, Nobel Prize-winning economist Milton Friedman said that the one thing that's missing, but that will soon be developed, is a reliable e-cash, a method whereby on the internet you can transfer funds from A to B without A knowing B or B knowing A. It seems that now we're engaging with this very technology he predicted. There are a number of myths and misunderstandings around blockchains and cryptocurrencies, and so I will spend the beginning part of this presentation explaining the technology in general. So the first and most famous blockchain currency is Bitcoin. In the 10 years of its existence, there have been countless pundits, experts and enthusiasts talking about the potential for blockchain to disrupt the global financial system. Blockchain even forms one of the pillars of the fourth industrial revolution. The problem is that it is largely misunderstood, and much of what makes people excited about it is generally misguided. Most people mistakenly believe Bitcoin was a response to the inflationary measures central banks undertook to prop up the financial system after the 2008 financial crisis. This is understandable since it arrived as the crisis was unfolding. And it has an Austrian economist notion of sound money baked into its philosophy. And this is typically the idea of a money supply that is fixed, that cannot be arbitrarily inflated by a central bank. So a lot of people have become excited by Bitcoin's potential to act as a form of sound money. And it harkens back to a digital type of gold standard. And in fact, much of the advertising that you see and a lot of the news talks about Bitcoin and it being a digital form of gold that will increase in value as central banks inflate their currencies. So there's a lot of excitement around that. And of course, a lot of people who are now wanting to jump on the bandwagon and make a quick buck, as well as scammers, of course. So the majority of people today believe that Bitcoin and other cryptocurrencies like it should be government resistant, something that government can't control or have visibility over. They're aiming to develop systems that act outside of a regulatory purview. The design of Bitcoin itself has been changed over time to allow for more anonymous transactions and a greater decentralization, which is supposed to mitigate against central points of failure. But this wasn't the original intention of its inventor. In fact, if you go and read at the writings of the inventor when he was creating Bitcoin, when it was being born, he talks a lot about large commercialized entities who maintain the infrastructure. So what I want to do now is I want to dive into a brief description of what a blockchain is, how it works, and what it is potentially capable of in a financial context. Let's look at businesses. Businesses generally have systems that can store records and information. This might be a database or a spreadsheet. It is not good practice to have a single instance of the data, and so copies are made and stored in multiple locations. If a single copy is lost, it is possible to recover the information by using one of the other copies. This can be described as a distributed system. A distributed ledger is a set of data that is copied and stored in multiple locations. Companies operate and interact with one another, and each of them stores data relevant to themselves. Sometimes data is shared amongst different companies that have relationships with each other. For example, there might be sales and invoicing information that needs to be reconciled between two different companies. A lot of effort is required to make sure that for every purchase order from one company, there is a matching sales order from another. If the information is not reconciled perfectly, this can lead to unbalanced books and disruptions in the flow of business. An ideal situation would be one where instead of having multiple sources of information, these companies share a single source. That means if a record was added by one party, the other would see it immediately. This data could then be shared by all parties and everything would be perfectly synchronized. And this is a basic description of what a blockchain is. So a blockchain can be generally thought of as a database or a ledger that is distributed and shared amongst multiple parties. An important and defining characteristic of a blockchain is that records written to the ledger cannot be edited or deleted. Now, of course, it wouldn't do for all the records from one company to be shared with a competitor, and so a blockchain ledger is used to only share information with another party if it is relevant to that party, or if it needs to be public. All the other information is kept privately. So why is it called a blockchain? Well, this is simply due to the data structure that is formed as records are created. During a period, records are collected and grouped together into a block. After an interval of some time, another group of records are collected and appended to the previous block, thus forming a chain of blocks and a blockchain. How is that ledger maintained? Well, financial institutions have data centers that process records. Blockchain organizations or companies exist that perform a similar function for the blockchain. These are colloquially called miners, and the processing of transaction called mining. What is important to note is that these are legal entities that must comply with all laws and regulations. Otherwise, they risk being shut down and losing their investment in resources and infrastructure. They have the ability to reject illicit transactions made on the ledger and an obligation to comply with court orders. The false narrative of blockchain developers is that this is something to resist. If a blockchain can only be maintained by a large, visible and compliant organization, then it goes against their desire to have a government-resistant network. And that's why we have a plethora now of anonymous cryptocurrencies, ones that go out of their way to make sure that records cannot be shared and everything is obfuscated. Another interesting aspect of a blockchain is that digital tokens can be created, and these can then be transferred to others. All a token is a digital representation of a real-world item. A legal contract could be defined which confers utility rights or property ownership onto a token. This is much the same as a dematerialized share certificate or a title deed. It is possible to tokenize any asset, utility rights or certificate of ownership, and then have it legally traded on a blockchain if all the laws exist. And this is what is happening today. Regulators and law enforcement are coming up with rules around how these things can operate. What is also interesting, though, is that it's not that a whole lot of new laws need to be created. All the activities that happen on blockchains today and that could happen in the future are already covered by existing laws. So where does this currency aspect come in? What is a cryptocurrency? Well, if there is demand for those tokens on a blockchain that will be repurposed as a utility or an asset or a security or something like that, if the supply of those tokens are limited, and if they are fungible, in other words, legally indistinguishable, and they can be traded on a legal and regulatory compliant blockchain, then you have all the ingredients you need for a digital form of money. Also, if the fees are low, and if the transactions can be traced. My company Centby has built a payment ecosystem in South Africa to make it easy for people to acquire, hold and spend Bitcoin. We have a retail footprint across the country that makes it easy for people to be able to purchase Bitcoin over the counter at most of the supermarkets around the country with cash. People can buy with cash or with credit card. Also, we have a bank integration, so you can connect your bank to your bank within the Centby mobile wallet, and you can do a direct EFT to purchase Bitcoin. Once you've got the Bitcoin, the wallet itself is a very simple wallet that makes it easy for people to be able to use it. And then, of course, most importantly, a way to spend those Bitcoins. And what we've done is we've integrated a number of value-added services into the wallet, like electricity and mobile data and Uber vouchers and so on. We also have a merchant payment point of sale. Now, of course, this isn't widely available, and one of the reasons why cryptocurrency payments haven't really taken off yet. I would like to talk about another misunderstood aspect of blockchains, which revolves around financial contracts. There is a concept in blockchain of something called a smart contract. And this has been magnificently hyped. Promoters and advocates breathlessly tout smart contracts as being devices that can completely disintermediate third parties from every business relationship. To understand what they aim to achieve, let's look at an example of a typical business transaction. Alice wants to trade with Bob. She has a barrel of oil that Bob wants to buy. But she doesn't know Bob, and she doesn't trust that he's going to pay her when he receives the goods. So Alice and Bob find a neutral third party that can mediate the transaction, typically an escrow. Bob gives the money required for the purchase to the third party. Alice delivers the goods to Bob. The third party sees that the goods have been delivered, and they release the funds to Alice. Smart contracts can supposedly replace the need for these trusted third parties. So what is it? Well, a smart contract is an autonomous unit of business logic. In other words, it acts on its own. And this is programmed as software into a blockchain. Then the rules of the business exchange, the provisions of the contract between Alice and Bob, are codified into the contract. Then Bob sends the money in the form of cryptocurrency to the contract, where Alice can now see it. Then, during the lifetime of that exchange, the contract is used to check that the provisions are fulfilled. Have the goods been delivered in good order? The required number of items? Has it been shipped correctly? When the goods finally arrive, the contract then autonomously releases the money to Alice, and the transaction is concluded. So this is something that is theoretically possible, but it will always be required that trusted third parties are involved to ensure that all the regulatory and compliance obligations are fulfilled. To have a smart contract conduct trade and financial transactions without there being any regulatory oversight obviously can lead to situations that might not be considered desirable. So smart contracts are useful given those requirements, and they can make payments extremely efficient. For example, it's possible to pay multiple recipients in a single transaction, which is very appealing if you're a tax authority. What I'd like to do now is I'd like to just go through an example of a blockchain in action within a supply chain context. This is a very useful example which really brings in all the aspects of blockchain, and so that you can see how it would work in a typical supply chain business transaction. Now what we have is here we've got a purchaser or a buyer of some good and a supplier. These two participants want to enter into a contract where the supplier will supply goods to this buyer. Now they need to enter into a contract. Typically what would be required is there would need to be a letter of credit, there would be banks involved. Let's see how theoretically a transaction can be concluded using a blockchain. So the first thing that happens is a smart contract is created and the two parties enter into that contract. In that contract, provisions are coded which say things like the goods need to be shipped on this particular day. They need to go through this particular customs authority. They need to be delivered to this particular warehouse. This is codified into the smart contract. What then happens is the buyer deposits money into that smart contract. And the supplier can now see that the money is available. And all the supplier needs to do is make sure that they fulfill the provisions. Now, of course, in a supply chain, it's there's not only these two participants. Generally, there are a number of participants in the supply chain that are involved to ensure that the goods are delivered in order. What the supplier does is they produce the good, and now what they're going to do is they're going to create a blockchain token which represents that good. Other smart contracts are created between all the different participants, which define transaction obligations between those participants. What happens then is that token is created and then assigned on the blockchain to the supplier. And now because it's on a blockchain, all the participants can see that a token has been created which represents that good, and it is now sitting at the supplier. The next step is the goods are shipped to the refinery in this case. The token is then reallocated to the new participant, and we can see now a trail of provenance because the records are not deleted. New records are created. Everybody in the supply chain can now see where those goods sit. The goods are then shipped throughout the supply chain. As the goods are shipped, the token is reallocated to the next participant. Everybody has visibility on the supply chain. Smart contracts between the individual participants are fulfilled and payments are created. And finally, the goods are delivered to the buyer, and the last item in the smart contract is checked off, and the money moves. Now, this is a great way to see all the different aspects of blockchain and where they can be used. As you can see, it's not just a financial thing. It can also be used to track the provenance of goods through a supply chain. We can see how there are autonomous smart contracts governing the relationships between the different participants. And we can see how money has moved without there having to be a letter of credit from a bank or an escrow or an intermediary. This is a great example of how blockchain can be used within industry. Now, of course, there are a lot of assumptions here. Also, there are a lot of regulatory aspects here that will need to be defined. And so this is largely theoretical, but this demonstrates the potential. And most interestingly, how the systems that we have today can be made a lot more efficient, because supply chain typically has a lot of complexity and a lot of things can go wrong. If you understand this, well, then you understand blockchain very well. The next question is, which blockchain? Because today we have literally thousands of blockchains. Now, are we going to live in a world one day where there are a multitude of blockchains for all sorts of different things? Or is it going to be more like the internet, where we have one internet network that everybody communicates over? I believe that it's more likely the latter, that there will be a single blockchain that is used for financial transactions, to track items through a supply chain. That to me seems like the more likely outcome. Over the months and years to come, we will probably see some sort of consolidation, and ultimately at the end, perhaps a single blockchain emerging. That period of time though is indeterminate, and we don't know how it's going to pan out. At Saintby, we have our own perspective on this. We believe that for a blockchain to succeed, it not only does it need to be scalable, in other words, needing to be able to accommodate all transactions in the same way the internet accommodates all searches and all information that is flowing throughout the world. Not only should it be scalable, it also needs to be extremely cheap to transact on. If transactions are expensive, people will use it less. But most importantly is that it needs to be stable. Now, the internet is based on a number of protocols that have not changed much over time. And that has given businesses confidence that if they develop technology for the internet, the underlying principles of the internet won't change, which means that they won't in the future need to make adjustments and updates to their software. And that has created the world that we see today, where the internet has flourished and businesses around the world have created enormous value for people. It is our belief that a blockchain needs to remain stable. Thank you for listening to this. I hope that it was enlightening and that you learned something, and all the best for your future.